Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Welcome to another edition of the Buy-In podcast. Very special edition today. We are a few weeks on from the federal budget announcement, and I am joined with some special guests. Our principal and licensee of the Septennial Group, Gareth Croy. Welcome.
Thank you.
Bodie, our Director of Accounting, is talking all things exciting stuff in and around tax and accounting. And, of course, my trusty partner in crime, Simon Podger, Director of Lending.
Why not special?
Not so special. No, you're my regular.
Okay,
so.
Old hand.
I want to jump right into it. Gareth, can I throw to you? What do you think now we've had time to digest with what was announced with the budget? We're a month on. What are your thoughts on what's been delivered and where we're at with it?
Well, so far nothing's delivered. So that's the problem. What has been delivered is political suicide. So some would say it's undemocratic what they've done. They've gone completely against what they said they wouldn't do a year earlier. And there's been a real backlash. So we've now started to see a lot of walk back from it to kind of figure out for Labor, like, what do they do now?
Yeah, absolutely. And as you could tell by the colour of my hair, I've been around for a long time and I've never seen so much backlash and media attention and social media posts in and around the budget. Simon, what are your thoughts in terms of all the noise that's out there?
Yeah, and I suppose that's it. There's so much noise at the moment, sort of thing. And as Gareth's saying, like, we've got all these proposals come through, but they haven't been pushed through yet. And not to jump to topics and stuff like that's causing a lot of angst in the lending practically, because I'd say like half my lending panel has adopted the changes, half haven't.
Yeah. The
ones that have, you've got to do these manual calculator adjustments to push through what they're changing and stuff like that. So it's causing a bit of disruption in the lending side of things practically, which is quite interesting.
And Bodie, from an accounting perspective, have you had a lot of conversations with clients, and is there much panic going on or jumping to conclusions? Or
I think it's created a lot of fear and uncertainty, and that's the big thing that a lot of clients are, I guess, wanting to know is what that means for them. So probably 99% of clients are going to be impacted by this. There's very few people that are untouched by the changes in the budget. So I think there's a lot of uncertainty. People want certainty. They want to know if their strategy is going to work for them going forward. And it's, I think there's a lot of fear, unfortunately.
Yeah, absolutely. I think from my perspective, in terms of the property space, I think a lot of people have hit the pause button, and they're trying to digest what impact it is for them. And it's been an interesting pause, albeit it's been only a short period of time since the announcement. And as Gareth, as you said, nothing is final yet, but everyone's already starting to posture of what might be. But the market has paused, which I'm happy about because it probably needed a pause. It was on a fairly decent run. And I think for the most part, it's an opportunity for a lot of people as well.
Do you think that people are now wondering whether property is still going to be as strong as it has been in the past? Will it come back to the way it's performed?
Yeah, look, I think for people that are not seeking professional advice, they could certainly fall into that trap. Property moves in cycles like any other asset class. And we're probably in markets that have suffered the most as a result of the announcement. They were heading that way anyway, and that's Sydney and Melbourne. Perth and Brisbane have been pretty resilient to what's been happening, but essentially, if people are starting to turn off property, it's probably a bit of a bad move, because essentially property is a long-term investment. This is only a short-term I guess, policy change, we don't even know if it's going to be long-term because, as you said, it's political suicide. So we may see some of these changes reversed in a couple of years' time at the next federal election.
So we've seen last couple of days Senate hearings into what's proposed, what's gone through the lower house is now coming through. Some of the experts that have been at the Senate hearings are saying that this actually will have the opposite effect. It's actually going to negatively impact on supply, which has been, I guess, what everyone has been saying for some time is that we've got a supply issue in Australia. So could it be argued that, in fact, now is the perfect time to invest because less supply means, we don't have less demand. So the fundamental is that prices should go up.
Yeah, absolutely. I mean, key markets, again, like I touched on, particularly Brisbane, Perth, they were already undersupplied. So, it's an issue that the intention of what the Labor government delivered on budget night is actually going to work in the opposite effect. It's not going to add to supply. It's actually going to take supply away to a degree because you're going to have panic investors selling out of property, which is going to reduce the rental pool, which is then going to push up rents, which is then going to make the young people that it was intended for further away from property ownership because we're in an undersupply. So we've got a growing population. We're bringing more people into the country than we're providing property for. So whilst that undersupply is going to continue, there's going to be that pressure on prices, which is going to keep pushing up. And, if people are paying more in rent, they're not saving as much. They're further away from having the relevant deposit to get into the property market. So unfortunately, I think it's having the reverse effect of what was intended. But I also think for an investor, it's an opportunity because it's paused the market. I don't think we'll see over the next 6 months, maybe 12 months, possibly max. I don't think we'll see a better buying opportunity in the next 5 to 10 years. So.
Do you think it's going to do the opposite? So for people that have negative gearing as investors, why would they sell now? Because for me, unless you're doing a new build, you're not going to have the opportunity to negative gear again. So I think from what I'm seeing in terms of some of our clients asking if it is a good time to sell, my answer at the moment is no, unless they need the cash.
Absolutely, our advice would be no, but there are some people that are not seeking that advice and jumping at headlines and media without actually understanding and processing it. And I think that's only going to be a small percentage of investors, and I'm already seeing it within some of the conversations I'm having, with agents and so forth. But I don't think it's going to be a huge impact in terms of, there are some headlines out there. Some people are saying the property market could decline by up to 10%. But when you look at it, for example, Brisbane went up 25% last year. So if it comes back 10%, to me, that's a correction, not a crash. And then, again, things move in cycles. So over the next 10 years, it's going to continue to go up. So, but I think it's probably not the right strategy is to sell now. But, some people are going to panic, I guess.
I guess that then leads into the importance. I mean, this budget, the winners out of this very much seem to be advisors because it is people are needing advice now more than ever. It's making sure that their strategies align to tax changes and legislation. And it is quite a difficult budget to interpret if you're not, or if you don't have an area of expertise in this area. So,
which could be reflected in this, as you're saying, there's this pause in the market, but practically people are actually reaching out saying, okay, I get it, but how does this impact me and what we're going to do going forward? And, coming back, not to take the talking stick back to lending and stuff like that, but practically if you had a conditional approval and then you found a property after these and one of your lenders adopted these changes, that may force a reassessment and it may not work anymore and you'd have to go and find somewhere else, which adds this delay sort of thing.
Yeah.
So,
do you think the lenders responded too quickly? Like basically took the announcement on budget night as gospel that it was going to happen?
Yeah, I think so. I mean, their proposals which have to pass through all these, as you said, there's a Senate inquiry going on at the moment, and lower and upper house and stuff like that as well, sort of thing. So they sort of fell back on that it was responsible lending that they had to change sort of thing.
Yeah.
But I think that was a bit of a scapegoat, to be honest, because they do a lot of things, how do I say it, commercially minded, which has nothing to do with responsible lending. So to come back to the answer, yes, I think they have. And that's why you've seen literally half the panel have swapped and half haven't. You know? And it's interesting to see that it includes non-banks and banks. So it's not just, the big four have done it and stuff like that. It's a whole mixture across the board of the lending landscape as well, which I thought was quite interesting.
How much does negative gearing impact within the servicing calc?
I did actually a couple of examples, and one was like a simple investor just purchasing one property if it was eligible or not eligible. The max borrowing capacity was, say, $1 million, and without it was about 942. So not a huge difference there sort of thing. But when you go to maybe a more complex investor, let's say they own 3 investment properties already looking to purchase a 4th one, the maximum borrowing ability was about $1 million versus about 800. So there was a pretty big difference there sort of thing on that sort of front.
And do the calculations sort of ignore that property losses carry forward? I mean, it's not that you lose that, it's just that you can't offset it against earned income. So do the calcs just ignore that and presume, well, this is all about whether you can afford repayments? Yeah,
I mean, pretty much that's what they're looking for. I mean, with the negative gearing, if it's turned off, it's just not been applied to your income sort of thing. So it's still been applied to the it's netting off, I suppose, you know, with the rental income versus the estimated property expenses, if that makes sense sort of thing. So that's where it sort of stops there. The other thing I thought was really interesting is ING came out the other day with it. If you've got a mix of properties, you know, so if you've got some existing ones that were eligible for negative gearing still, and then you're purchasing a new one, let's say a new off-the-plan unit, that they won't do any negative gearing at all sort of thing. So they'll just exclude that one.
All of it.
Yeah, and I'm assuming that's because of practicality reasons, that the calculator hasn't probably been updated enough to be able to do that switch, that it's all either all in or not.
Yeah.
You know, so
it does get complicated and sophisticated.
It does. I mean, this is why these practicalities are flushing through, and maybe that's why the lenders jumped early to try and get these things through, and with credit policies and stuff like that. I don't know. So, but that's sort of where we're at the moment with lending sort of things. So stay tuned.
Yeah, devil's advocate. Let's say that the report that's coming out on Friday from the Senate hearings, they decide that, well, the Greens don't support it, and they go back. How quickly do you think the lenders might walk back from some of those changes that they've made?
Well, they implemented them quite quickly, so I'm assuming they'd, you know, unimplement them quite quickly as well if that was the case. I mean,
sometimes they can be sticky though.
Yeah, they can. And then that, I suppose, adds to the confusion of what's going down the line. I mean, they're lending out on a 30-year loan. Yeah. You know, so they can be, how do I put this, somewhat short-sighted at times sort of thing. But they've got to make a decision at this point in time.
Is there a commercial reality to it though, where they go, look, if we don't walk back from this, I'm being devil's advocate. Yeah. Are they then uncompetitive and they will lose? They won't get the volumes they need, so they're kind of commercially or market forced into doing it.
Pretty much. I mean, that's it. The lenders here lend money, you know, by lending it out. You know? So if they're not doing that, you know, their shareholders will be on their back. Their share price will drop, and that causes other issues and things like that as well. The dividends will drop. So
we haven't really seen shareholders push that. Like, why wouldn't a shareholder now say, why have you brought this in when it's not actually in legislation yet? We're missing out on volumes.
Yeah, and then that could happen, you know, with proxy votes and things like that, AGMs and all that sort of stuff as well. So quite interesting at the moment. So
with the level of competition for lending, and you would see this, I guess there's more than just the big four, you would think they'd be putting themselves at a disadvantage, pulling the trigger early when it's government intent at the moment. It's not legislated.
I know, and that's why I thought it was very surprising. You'd think like, okay, it'll just be the big four that'll jump ship straight away, that like the conservative guys and stuff like that, but it hasn't. It's been this whole mix of even non-banks, which you think are sometimes, let's say, more aggressive, you know, because they haven't adopted the APRA 3% interest buffer. They do their own thing sort of thing, which is fine to capture business, whatever. So you think it was on the similar vein of that they'd want to be out there just, you know, waiting until it is actually fully legislated before making the changes. So,
maybe it's a treasury thing where it's a, you know, cost of funds that when they're packaging them up, that if this comes through and they haven't catered for it, then there's some extra weighting put onto it, which higher cost of capital or something.
Yeah, it could be, and then maybe the investors see as a high risk because that hasn't been done, previously when it was, the loan was put in place and things like that. So maybe that is what's directing them, that they think that'll happen down, thinking long term when they sell them. So. Yeah.
Are you shocked with the RBA announcement yesterday, considering all the fear that's been, I guess, generated from this budget?
My view is that they really did need to take a hold. I mean, 3 interest rate rises is pretty dramatic in my view, one after another sort of thing. And I know what you're saying, that, there is a bit of, Iran still kicking around. There's a deal, there's no deal, who knows sort of thing at the moment.
There's a deal.
There's a deal, okay.
Just ask Donald.
Yeah, on that note, apparently they signed it digitally, which I thought was quite funny. I'd love to see.
Using Adobe Sign.
Yeah, Adobe Sign or DocuSign came through there, and everyone, doing their verifications and everything. So, but coming back to the point, I think they just needed to take a breather and see. I mean, whenever they do an interest rate rise or a movement or a decrease, you got to wait until you see the data of what the impact has been, sort of thing. Moving before that's come through would have to be something dramatic. We saw that, I think, in the GFC, where they knew, okay, we've got to act now, sort of thing. We can't wait. I think they dropped it at one time by a whole percent, sort of thing.
The argument is that, these gradual increases, it's uncertain times. So is there more rate rises coming, and what's that effect on affordability? So I guess the question, the uncertainty comes from this budget announcement hasn't really come through yet. And there's this constant conversation around, is government spending actually our biggest enemy right now? Is that what's driving inflation? And so is the pause button because the RBA don't actually know how much government spending actually coming through to understand how much impact they will have, on inflation.
Yeah. And it's tough for them because as we're discussing, that it's not legislated yet as well. So they're sort of, like the banks, they're guessing too, sort of thing, and trying to understand how this is all going to play out. So the long-term fixed rates did increase quite dramatically, but even those are starting to sort of trickle back down, sort of thing. So I think that the long-term approach is, okay, we're probably done, and the next ones will probably be, decreases. Just will it be at the end of this year or early into next year or something like that?
That's what CBA, NAB and ANZ are forecasting is the next move will be a cut, probably not until 2027.
Yeah.
So there's only one of the big 4 that are actually saying that there might be still another rise in the current cycle.
Yeah.
So obviously our major 4 lenders aren't all completely on the same page, so they're guessing as well.
Yeah,
I think a lot of because they have access to a lot of data, and so this is all driven, I guess, out of confidence, how people are feeling, whether they're spending or not, and that's everyone sitting on their hands. And so it's conceivable that to really jumpstart the economy, they're going to have to do something to make people feel, okay, we are at the top or we're coming down, so we don't need to, keep a bit of cash in our pocket because it isn't going to get any worse.
Yeah.
Gareth, can I talk broader economic side of things? Like, you touched on before how obviously the banks aren't going to sit back and watch their business dwindle over this. Another one for me is if property transactions are at a reduced rate, that means less stamp duty for state governments,
100%.
Which then has a knock-on effect of reinvestment into things like infrastructure and just generally bringing each state forward or the country forward. So, where do we stand economically here? Because it's impacted so many different things. And as you touched on, productivity is what we need in this country to take the country forward.
Yeah. And productivity is a byproduct of confidence. And so, there's not investment into expansion within businesses, et cetera, when there is no confidence. And so it's a big challenge that they've sort of created for themselves. I think the first part of your question, when we think about state governments and their revenue sources, you're dead right. There's a lot of transactional revenue that comes from stamp duty. But you've got to remember that they also make a fair bit of revenue out of land tax. And so I'm not sure what the consultation was from federal to state level to talk about the modelling and the impact on revenue around land tax that has an immediate impact or long-term impact to the state government budgets as well, because they would have modelled out based on growth rates. If those growth rates are affected, it affects their revenue.
Talk consumer sentiment. It's fallen to 80.6 on the Westpac Institute Index, which is the weakest reading in the survey's 50-year history. Yeah. That's scary.
But that's the climate we're in, where when you have uncertain times where it's really unclear, we are a month on from the budget and, all of us as advisors are sitting here trying to navigate this, but we don't know. The Senate hearings the last 2 days, there's still strong debate on both sides. So it's not clear that one sort of path makes more sense than another. And so that uncertainty just leads to, paralysis where people do nothing.
Yeah, absolutely. And that's obviously from a strategy perspective, that's not going to help you get to where you need to get to. So it's about getting the right advice, staying true to your long-term strategy. At the end of the day, this budget announcement, albeit, as we've said, hasn't been passed, is there more to be said around confidence if things like the Iran war is over, petrol resumes to hopefully a more palatable level, we get inflation under control, and potentially interest rates come down from where they are now? I think that's going to go a long way to restoring a lot of consumer confidence.
I think so, but I think the backdrop of this is that the damage is being done now. So, we're in a global economy now. People freely move around globally with work. And the challenge for Australia is that all of a sudden it's become incredibly tax heavy for people, or could be. And so they're seeking alternate tax jurisdictions because they can work or they can run their businesses from other places. With that drain coming out of Australia, you will not turn it around with confidence coming back in 6 to 12 months. The damage is done. It's unlikely people would return. So the damage is being done now because people are seeking certainty. Yes, all the factors you talked about will play into how we feel from a sentiment point of view. Not everyone's going to leave the country, but it certainly will leave us with fewer taxpayers as a result of that confusion.
What sort of people would that suit? Is it entrepreneurs? Is it, the mum and dad? Who does that suit, that sort of strategy?
Yeah, so the real, conversation for Bodie and I and our talking to business owners is around, if you're doing a startup, it doesn't need to be in Australia because maybe it's got a global audience, global clientele. Is Australia the right place to start that business? Is that where you would invest and set up a company or your business? That's the question we're facing, which maybe the answer isn't yes anymore. So they are seeking out other places that they can still service their international clientele, but no longer is Australia the right place to be based.
I think just to add to that as well, the CGT proposed changes are significant because startups are cost base of zero. So when they go to sell, that CGT impact is huge, and that can be debilitating in terms of what their strategy is going forward.
Yeah, and we're out of line with the rest of the global economy with that. So when we're thinking about other first world countries, they don't have CGT on those sorts of capital gains. So.
Or the other way, they have incentives to get them off the ground and stuff like that, or exemptions or whatever when it comes time to sell and all that sort of stuff to entice people to take that leap and risk.
And that is the debate at the moment that is going on, is that, as Bodie said, this cost base from zero, that's a lot of tax to pay if you are successful and you're penalising someone from giving it a go. That's un-Australian.
Yeah.
So let's try and take a little bit of a change of pace here and make it a bit more positive, because it seems like there's a lot of negativity around this. There's got to be some silver lining to everything that's going on. So what are areas that we should be focused on?
Well, I think uncertainty creates opportunity.
Yeah.
So generally speaking, for all those people that are sitting on their hands, the people who actually take action will be the ones that probably succeed in this. The reality is, as you already said, it's highly unlikely that there's a lot of data to consider in where you invest or what you do. And it comes back to Bodie's point about advisors being more important than ever to get the right strategy. But there are opportunities just simply because there's uncertainty.
Yeah, one of my favourite quotes from a quite an experienced investor in The Godfather, Warren Buffett, has stuck with me for a long time, and that's when people are greedy, get fearful, and when people are fearful, get greedy.
Yeah.
Mm-hmm.
And I think the latter is where we're at right now.
Yeah.
So
The commencement of COVID, the real winners in COVID were the people that purchased when COVID first hit.
Yeah.
And
True. Good
the
point.
property market went gangbusters from there.
yes,
So is it a scenario like COVID, do you think? Because COVID didn't pose any tax risks, any tax consequences.
I think from a mental perspective, it is.
Mm.
It's really about, having a strategy and staying true to that strategy over the long term. And a strategy should overcome any event on the journey, because really it's about where you're trying to get to over the long term. And yeah, look, I mean, good example with COVID. And even when the headlines and even the banks, Simon, were coming out saying the property market's going to crash 20%, it actually did the exact opposite. So please don't take your property advice from a bank.
Which bank?
Yeah. I'm not saying. But yeah, it's really about, having a strong mindset through this process, because if you're fearful, like Gareth touched on before, procrastination gets you nowhere. Sitting on your hands gets you nowhere.
I think if you go back to, regardless of whether it's property or shares, if you understand the fundamentals, it will give you the confidence to take action. I think if you're reading headlines and getting your advice from the media, then you're probably, you're probably too late to the party, but it's also probably not the right decisions for your own circumstance. But again, if you peel it back to, well, what are the fundamentals, then you can have a lot of confidence in making decisions in times that seem quite tumultuous.
That's right.
Can I just come back as well, is that it just comes back to this long-term outlook strategy. And if you go back, you got COVID, and I come back to lending with, do you remember when they did the interest-only cap changes and the cap on investment lending and things like that? Prior to that, the GFC was mammoth and stuff like that. But if you just, weather the storms, of course, you might have to take some change of direction tactically throughout that, whether it's, do I purchase in this entity or that now sort of thing. But fundamentally, it's I'm here, but I want to get to the in a better light. I just have to navigate this storm. That's all it is.
And I think, as Gareth said earlier, it presents opportunity. Tax is never the strategy.
Yeah.
And whilst it pains me to say that because it is my career, it's never the strategy. It's a consideration that we have in the strategy, but it's not the core strategy that we're trying to achieve. So.
Yeah.
And I think for everyone listening to this, what's really important, and Bodie, maybe you can talk about the anti-avoidance provisions in Australia, where if you're making decisions solely on tax, you're actually going to find yourself in hot water.
Yeah.
And so if that's your sole reason for making a decision, these anti-avoidance provisions come in. So maybe we're going to see some of that if there's a knee-jerk reaction to the changes where people are adjusting simply for tax.
Yeah, it's true.
And I guess the considerations for investment, you're looking rental yields, interest rate, expected capital growth, cash flow, risk profile. It's those alternative investment opportunities and not purely just the tax side of things.
Just a bit of an analogy. I think the tax benefits are really the oil that goes in an engine. The fuel that goes in an engine is the lending, but the engine is the actual property and the strategy. So coming back to your point about COVID as well, the one thing I want to touch on is the market has become a lot more fragmented now. During COVID, and people didn't know this at the time when COVID broke out because there was a lot of uncertainty, but dare I say it, if you invested in any type of property, you probably did okay through the COVID period. I don't think those rules apply right now. I think we're very fragmented. I think the strategy has to be on point. From my perspective, and please, this is not general, this is general advice, don't go out and act on this. But from my perspective, it's more critical than ever to be in those inner and middle ring suburbs in larger capital cities. I think the outer ring suburbs, the rural locations, I think will struggle over the coming years. So the strategy is key now, whereas previously people did okay even shooting from the hip and just investing in property.
Just talking like those regional centres that really, they benefited through COVID.
They did, yeah.
There was sort of, I guess, this change. People wanted to move out of the cities because of what was going on at the time. And now a lot of people worked out based on certain occupations, they can work from home. Where are the regions at now? Is it, affordability? Are they still popular? Where are they sitting within the cycle based on what you're saying?
I think it's going to come back to employment as well. If the employment opportunities aren't out there, why would you go out there? I think it's interesting because I think in markets, particularly like Sydney and Melbourne, where it has swung back into a buyer's market, I think there's more room for negotiation. I think it's going to lure people back. I even think to a degree, some people might move back from, markets like Perth and Brisbane back into Sydney and Melbourne because there is a buying opportunity now. So people will move, people will adjust to opportunities and circumstances that are presented. So I think the rural areas, I think the further we get away from COVID and I think people start to forget and they come back to where the opportunities are, is my opinion. So
just the end of the tree change. Is that what you're saying? Is that what it was?
Well,
cityscape.
Again, I think the thing that I have said all along, I really don't like, and I'm not suggesting you are, but I really don't like when people generalise when it comes to property. All the headlines are out there at the moment, off the back of the budget, off the back of interest rates, everything. All the stats, all the data, everyone generalises in property. You really need to get the strategy suited to your individual circumstances. And sorry, I know that's not what you were saying, but essentially I think, yes, to a degree it will, but there will always be pockets where things move in cycles. What's happening in rural WA is not what's happening in rural Queensland, which is not what's happening in rural Victoria or Melbourne or Sydney or et cetera. You've got to get down to the microeconomic fundamentals of what's going on in a market. So
it's really interesting you point that out because, I live and breathe in other asset classes as well as property. And if I think about shares and bonds and other types of assets, there are index funds, so we can invest into an entire market like the ASX and track that without having to pick an individual stock. There is no such thing in residential property. You cannot get an index that you can go look across the entire market. I want exposure because I know over a period of time it will go up by X. That doesn't exist in residential property. It is very much down to filtering to the asset that suits and then a specific market that works for your strategy.
Yeah, absolutely. And that's why when we work with individuals or clients that are their strategy is looking to build a multiple property portfolio, the recommendation is always to have geographical diversification so you don't have all your eggs in one basket.
Yeah.
So with these changes, let's assume that people have maxed out their super because that's still a pretty good vehicle to invest in and stuff like that. Maybe they've got a few investment properties, so looking for elsewhere to invest. Is investment bonds now back on the cards, which previously they sort of weren't as popular, let's put it that way, sort of thing?
Yeah, so they definitely have become more of a household conversation. They've been around for a long time. Why they've become more popular is because of the investment choices you can select within them. But really they had their day, it became more, I guess, more awareness through the Division 296 introduction around super. So over $3 million, you're now paying 30% tax. And so based on the tax packaging within an investment bond, it's significantly lower. So if you're holding an investment between an investment bond or over 3 mil in super, you're better with the investment bond. That's now a conversation because we've got these changes to discretionary trusts. So the minimum tax rate proposed is 30%. So yes, you are basically getting a concessional tax rate through an investment bond, as opposed to what you would be doing with the discretionary trusts if these changes come through.
Yeah, because was the general gist was, right, I'll invest in my personal name, and then once I then pull out of the workforce, then that's when I'll sell them when my income's low. But obviously now that's gone out the window with the minimum tax threshold that they've put in there, sort of thing. So hence, with the bond, if you've held it for 10 years plus,
it's tax paid.
Yeah, there's no CGT that comes into it, sort of thing.
And it goes back to what Trent's saying. Like, this is true investing. Like, a 10-year horizon is investing. It's not speculating.
No.
And it is about funding, whether it is perhaps like, one of your goals is to leave the workforce early. An investment bond's a good option because, quite often that'll be a 10-year plan. And that is a great vehicle for providing potentially, some funding when you hit 55. You can't access your super yet, but you might want that 5 years out of the workforce. Take out the money tax paid and use that to fund your 5 years until you can access your super.
Yeah. I mean, how I got told they was sort of like for grandmas to put money away for kids' education and stuff like that. But I think that's going to have to be totally respun with the marketing team and stuff like that.
That still works for grandmas.
Yeah.
Let's not rule that out. But, we've seen this with clients too, that it's not just grandparents, it's also parents now, where as soon as their child is born, they're thinking about setting up an investment bond because they want to fund private school fees in high school or university fees. Again, great vehicle for it, and seems to logically make more sense than, say, a discretionary trust would have in the past.
Yeah. Yeah, no, interesting. Can I throw another one on the tax sort of side of things? With how they've done it, when we're talking about trust, we're bringing in this minimum 30% and stuff. Would it not have just been easier to have household incomes being assessed without that? I mean, they do that, in Centrelink and other things and stuff like that anyway. So it's like, because obviously they were trying to avoid people shifting money through a discretionary trust to people on lower incomes and stuff like that. It just seems you could have done this a lot easier, guys, so.
Yeah, absolutely. I think it's they use the word that it's helping create, or it's stopping tax breaks for the super wealthy, which is completely inaccurate. Like the trusts and the company setups that I have in terms of our client base, they're not the incredibly wealthy. They're the mum and dad businesses, they're the mum and dad investors who are trying to make tax effective decisions. So I think the target there, they've really gone after the wrong demographic of population. And they're so deeply embedded at the moment. I think if this legislation changes do come through, there's going to be a whole lot of restructuring over the next 3 years. And for what? If we then and I mean, it's fair to say this, I don't think this government will get back in unless they do something major to restore the population's trust in them. So if we then spend the next 3 years, say, restructuring these trusts to then have a new government basically make additional changes, it'll be all for nothing. So I think that's where I'm disappointed in the fact that they've gone after trust, and then the picture they've painted with the media is that it's the super wealthy that they're trying to target. In my opinion, that's not accurate.
If I was going to jump on my soapbox, which I'm going to,
Please.
it would be far better for the country to go with a consumption tax than income tax. It's what most of the leading economies are doing globally, where the tax revenue is derived by how much you're spending. So the people who can afford it are paying more of the proportion, and it's based on what you're spending as opposed to what you're earning. And it's probably more Australian. It's more incentivizing you to earn more without being penalized for it. And so, and the administration of collection of taxes is far more efficient doing it through consumption taxes than it is through income tax, particularly when it's so complex with all these changes. So, we're getting to a point where it becomes very difficult for an individual, even if they're an employee, to lodge their own tax return. That's insane. This is where there's this inefficiency that Australia's really struggling with, and it's impacting, into productivity, which will, is a longer term problem for the country.
Yeah, and if I can get on my little soapbox as well, or all that sort of thing. Yeah, up here in these clouds. But it's sort of like we sort of needed full-blown tax reform, not these tinkering as well. Sort of thing. It's like, well, okay, Australia's in this place at the moment. Where do we want to be? And then reverse engineer it to how it's going to work.
Take it to the polls. Like, come out with your policy, have it well considered so you can actually answer the questions we want answers to, and then let the public decide. These sorts of tax reforms really need the buy-in from Australians, not, hoodwinked and pulled out at the last minute. I think that's the backlash we're seeing. There is lots of opportunity for reform to simplify the tax system in Australia, which would lead to significant cost savings in government spending. And that just flows through to us feeling more wealthy.
Yeah.
I think the lack of productivity is just not going to balance the economy. So it's going to be a real issue where we're probably creating a larger issue for generations to come as a result of this.
What does that mean for retirement? So at the moment that people, and there's a lot of people out there that don't build their wealth inside of super. They build their wealth via properties. They're the ones that are being targeted. So does that mean that we then need to forward plan for additional pension payments? Or from an economic point of view, they might be shooting themselves in the foot.
Well, yeah, I mean, we've been saying for a long time, when they first introduced the pension into Australia, there were 64 taxpayers for every retiree. By the time somebody right now in their 40s retires, there'll be one taxpayer for every retiree. So if people haven't got the encouragement or rewarded for taking initiative in creating their own wealth and taking care of their own future financial security, how is the government going to be able to fund pension for a large proportion of our population?
Simply put, they can't.
Yeah.
You simply can't.
I mean, if we take a spin on the one good thing that they did in the budget, they didn't touch superannuation.
Was there a good thing?
They didn't touch superannuation.
Yes, that's true.
Yeah.
Yet.
Yeah.
No.
And they did carve out. So, look, whilst there's still some discussion in the Senate about whether they should or shouldn't, at least they didn't touch that, property inside super.
Yeah. And I think for an opportunity point of view, potentially this is the time, if these legislation changes do go through, maybe it is the time for people to revisit super, self-managed super funds, concessional contributions, and actually really hone in on building wealth inside of super.
Yeah, and look, I think, for the most part, there's a lot of Australians who don't know where their super balance is sitting in comparison to what they need in retirement and what action, if any, would need to be taken to get them to sustain a lifestyle they're used to. That's a real challenge. It doesn't help that the number of advisors has shrunk in Australia, but that's the modelling that every Australian should know is, am I on track?
Mm-hmm. Yeah, which, I don't think people have taken super seriously for quite some time, and they just don't see it real. They sometimes don't even take it like it's real money, but it's like it is. You should be like, keeping an eye on it and seeing if it's on track and what can I do to make it better.
Yeah.
Or even to a lot of people just stick with the industry fund that they've been given in their first level of employment. So that might mean that the assurances are not appropriate. There's no strategy around how it grows. They're not aware of the tax impact if you're making additional concessional contributions or the compounding nature of it. Or I guess we delve a little bit deeper into self-managed super funds and then the opportunity for property inside of those.
They're also sitting at the same risk profile they selected when they took their first job at 2021.
Well, often they look at the performance and say, well, I'd rather have the higher returns than what I originally ticked as a balanced investor or the default, and don't understand what that actually means. And so, we saw tragically a lot of people in that last couple of years before retirement get hammered with GFC because they just didn't understand what being a high growth investor actually meant. They saw the performance, they assumed that was going to happen every year, didn't understand the volatility they're carrying. And so often that strategy just doesn't come through because they're not consulting with anyone about, is it suitable for me anymore?
Mm. Yeah, exactly.
We're looking at the moment out of interest. Industry funds have, in the media, they have been, sort of shown up to a lack of performance and against other types of super. Analysis that we've done recently, our our balanced portfolio is, sitting at 50-50 between defensive and growth assets. Our growth portfolio is 70-30. Effectively, the industry funds at the moment, several of them have actually got their balanced portfolios sitting at 70-30 the same way we have our growth. And so you've got this significantly higher volatility. And I suspect part of that is that they're trying to increase the performance or returns because a lot of their members only look at that. They don't look at what is the actual allocations. They're just simply looking at, well, what return did I get for the year?
I think something that you said in a recent meeting that I was in with you is that industry funds are set up for the majority of people, whereas your net wealth accounts or your platform super, that's actually tailored to someone's specific needs. So, i.e., are they approaching retirement? Could they be more aggressive because they're in their 20s? So I think the industry funds, people maybe have a misconception that they're not directly for that particular person. They're made for the vast majority. Yeah,
for everyone that ticked the same box. And so there's a broad spectrum of people within that range. Fund manager, the trustee of the super fund has obligations to those members. I'm not saying they're doing a bad job, but they're catering for the average across that group as opposed to individuals.
So property inside a self-managed super fund.
Well, that's an interesting one because the tax benefits inside a self-managed super fund aren't as great, are they? So I think there's a real opportunity if people do have self-managed super funds set up to
Let's unpack that because the tax rate is 15%, 10% at the moment on capital gains. So arguably it has got better tax benefits than outside. It's just that the tax refunds aren't as large because the tax rate's not as high.
Yes.
But if you look at the actual overall tax paid, it's lower.
No, that's true. Sorry, where I was going with that is it's not as big an impact from a budget around negative gearing perspective. So I think for anyone that's got a self-managed super fund or just starting or setting one up, I think there's a bigger opportunity right now to negotiate on existing good quality existing property and get a bigger discount because, as we know, self-managed super fund property has to be purchased on a single contract. So the only options really typically are with new property is either units or townhouses, which I probably wouldn't recommend. So I think there's a real window right now with self-managed super funds for existing property, good locations, good quality property at a discounted rate. So, yeah.
And the tax advantages of those are when you do get into retirement and you move that to pension phase, tax-free. So
yeah, exactly.
For now.
For now, yeah. Yeah, exactly. So just on that, so I just want to touch on that, because going back to property, going back to new versus existing, obviously with the proposed budget changes, new property still attracts the negative gearing benefits. But I would be very, very cautious right now of considering new just for the sake of a tax reason and going with an off-the-plan unit or, a new townhouse because at the end of the day, property is a vehicle for creating wealth. I feel the best way to create wealth in property is through the long-term compounding growth of property. And I just don't see that off-the-plan units and townhouses giving the same results as freehold houses with land content over time. Historically in Australia, land has always outperformed building. Land appreciates, buildings depreciate. So I think, for the people that aren't seeking the right advice, they are rushing into units just for the tax benefits, but they're not going to get the capital growth that they're looking for. So I think it's a bit of a flawed strategy.
Absolutely. And it comes back to that tax shouldn't be the strategy.
That's right.
It should be the capital growth, the wealth creation, smart investing, structuring it right, because even with the changes with trust, there's opportunities now for investment, perhaps in companies or in fixed trust, because fixed trusts weren't actually impacted by the proposed legislation.
And that's capital growth is the main driver. It's the strategy. It's what we work for. But cash flow is actually what keeps us going to be able to achieve the capital growth. So you do need to find the balance, and that can come from various ways. It doesn't necessarily need to be tax. Obviously, we need to look for the right balance of yield and the right lending and so forth. But I think the future of just a slight reduction in interest rates will take a little bit of the impact away from people's negative gearing concerns. So,
yeah, I agree. And I think it's funny you talk about that there's an opportunity there at the moment to buy a second-hand property in SMSF at the moment sort of thing. I know we joke that, they could change the legislation, but at least they've grandfathered the legislation changes as well. So you'd have to say that either party has learnt from that that should be put in place for any changes if we were to change something. So hopefully that wouldn't, change anyone's investment strategy or tax-wise anyway.
I guess except those poor people pre-1985 that are now caught up in indexed CGT.
Well, I was going to say, I think everyone thought that was just some golden wall that would never change ever because it's been sitting there for so long and there it goes, sort of thing. And
that's a lot of transgenerational wealth that's going to be affected there. That's really those those large family portfolios that typically pre-1985 that because of those tax concessions they've held on to.
Yeah,
now
like inherited the family home or something like that.
You'd almost wonder whether they're trying to push them into selling them to try and bring that supply to market.
Yeah.
From a lending perspective, do you think these changes might result in people going with interest-only loans as opposed to P&I or principal and interest, sorry?
Yeah, I mean, so the interest-only loans for serviceability actually work against you sort of thing because they'll do the residual. So if you get a 5-year interest-only loan with a 30-year total term, they'll base the interest payments on 25 sort of thing. So it actually does work against you anyway sort of thing. In real terms, it doesn't. What I'd see is once to see the dust settles and like what Gareth said earlier is seeing, well, how is their actual volumes of new business coming through being affected? They may make other changes. Previously there was a lender, they've changed their calcs now, but which didn't have negative gearing anyway. The results came in about the same anyway, with a lender which did do it sort of thing. But I suppose what I'm trying to say is that you could see some of those changes coming through to attract and gobble up business. So, yeah.
Do you think that with the changes or proposed changes that, the mum and dad investor might now swing to commercial?
I think it should definitely be a consideration, certainly within a balanced portfolio. Once again, you don't want to swing violently the other way because of tax reform or changes, but I think in the case of balancing a portfolio, it might be, well, yes, I've got a residential investment. Now I've got capacity. I should look at a commercial investment. I think it's probably a really strong consideration. Yeah.
I mean, we've been around a while, and back in the day there was, I guess, a strategy from a client to build out a portfolio of residential property at a price point 10, 15, 20 years ago that was more possible. With lending, the borrowing capacity just isn't there for that kind of thing now anyway.
Yeah.
But the equity is. And so, that's where, regardless of the budget changes, was that inevitable that, there's a willingness or an eagerness to invest into property, but you're tapped out with residential borrowing because of NCCP, responsible lending, that there was a natural shift towards diversifying into doing resi and commercial.
Yeah, and like from the lending point of view, a lot more lenders have now come on board as well with a variety of different products. And because it's not under NCCP or responsible lending, they're more freer to make a commercial style transaction with whatever risk they're happy to take on board, So some of those are, they don't even need to see the income personally or your personal stuff. They're just happy to look at whatever the lease is from the property.
Interest cover.
Does that cover the loan? Yes, great. Well, let's move on sort of thing, So, yeah.
So the reasons being is just due to yield essentially. So you're typically not negatively gearing with commercial properties, generally speaking. Is that correct?
Yeah.
Yeah.
Okay. Generally speaking, yeah. I mean, with the yields are a lot higher sort of thing on that sort of front. So, yeah. Hence why those loans can operate, just to cover those repayments. So
again, it makes me laugh because it reminds me what you've just said there. It reminds me, please don't go to a library and go to the property investment section and borrow a book that's 25 years old.
Oh, yeah.
That's 0 to 180 properties in 7.5 years because that does not exist. It's unrealistic. Yeah. So, look, I mean, so much has changed. So talking about change, I'm just going to read this out. When the Hawke government removed negative gearing between 1985 and 1987, rents in Sydney and Perth rapidly went up. Rose sharply. The two cities both had supply shortages at the time. So scarily, sometimes history has a way of repeating itself. So the policy was then reversed within 2 years precisely because the rental market tightened so badly. Predictions, people. Do we think the same thing may happen?
Well, this is an interesting thing around, I guess, tenant protection legislation. So back 1985, 1987, there's a few other things that were going on, but there weren't the same protections in place around rental price increases. So there's a real strategy in that in itself, because the amount of changes you're allowed to make within certain periods of time are different by state. And so I guess that leveraging or ratcheting effect on rents might be a bit different from back then. The challenge for a lot of people is that, if the market is tightening, there's less supply of rentals, the landlord's more inclined to ratchet it even higher so that they don't miss out on rent because they're locked into that price for a period of time. So it could actually be amplified from what happened a number of years ago.
Well, if we trust budget night, rents are only going up $2 a week, right? So
yeah, it's less than inflation.
Yeah. Random number.
Yeah.
Yeah. Any predictions, Bodie, Simon?
I think same with Gareth, that supply and demand, that the supply is not there. And whilst the government has said they've got intentions to increase the supply, there's been no legislative changes or comments around how they're going to do that. So I think, unfortunately, simple economics is that supply isn't going to increase by the way that demand does, so rents have to go up. Just
on that, they've predicted that they will deliver 75,000 new homes over 10 years when we're already in a 4-year projected 385,000 home shortage. So to me, the maths don't stick up. It's not going to close the gap.
Yeah, HIA said on Monday that their modelling shows that the effects of what they've introduced will actually reduce the amount of supply by 20,000 houses a year. So this is actually making it worse than better. Yeah,
exactly.
I was going to say, and speaking to builder contacts and stuff like that, how hard it is to get trades and things like that. So you can't, let's say, build an army of trades overnight to handle this new supposedly demand that's going to come on board of new investors looking for this new product as well, sort of thing.
Well, not to mention adding to supply to produce new homes. Over the last 5 years, we've seen a 60% increase in the cost of building. So it's not exactly affordable for everyone to, create that supply that we need.
And I guess Southeast Queensland in particular, the Olympics are coming up. So all of the trades that are, I guess, at the moment building houses are going to move towards government contracts because that's where the money is. So there's no, incentive at the moment for traineeships, for people to learn these different trades or grow in these different trades. Hence, the supply in building is going to be reduced as well. Yeah,
significantly strained.
And I was going to ask on the property front, assuming these go through sort of thing, where you see people buying over for new properties, paying a premium, let me put it that way, to lock in these negative gearing changes.
Again, we keep coming back to it shouldn't be the driver. The tax side of it shouldn't be a driver.
I'm not saying for our clients, but let's say the sheep, let me put it that way.
Well, yes. Yeah, the sheep maybe, yes, definitely. So, yeah. Simon, you're not going to avoid me. Prediction?
I agree. Unless there's a new supply of rentals coming on board, like where else can prices go?
Outside of property though, guys, 2 years' time, where do we see things?
In which state? In terms of property, there's some really different policy in different states at the moment around what they're doing to rezone land to try and encourage supply. There's infrastructure that's going into certain states that other states don't have the money to do. So I think there's, to your point earlier, a real differential in cycle. And so it's hard. There's no blanket answer to your question, I do think that there's some real headwinds for Labor going into the next election. And right now we're sitting in this unique position where, the LNP is not the preferred party either. And so there's now a 3-horse race going into the next election. So I think the election will be won on solid policy. And quite often, people don't get into the nitty-gritty of policy. I think they really will in the next election.
Yeah, I agree.
Yeah, that's true. And that may be one of the very good positive points coming out of this is people will actually stop listening to sound bites and actually take a moment to understand how powerful their vote is, to actually read what they're actually voting for and what the candidate stands for. So,
if they can trust them to follow through.
Yep, that too.
Well, we've covered a lot of ground today, everyone. So thank you for all your contributions and comments. The one thing I'll say, though, is please ignore the headlines, ignore the hype and all the media attention. Strategy is king, and we'd love to talk to you about how that affects you and your future. Thank you. We'll see you on the next episode.